Welcome back, everybody. Uh, this video will be video number one in a, about a four-part series where I will be well, I don't think these are new concepts. They probably would have been used in different ways or explained in different ways and shown to be applied in different ways as well. So what I'm gonna be sharing with you today are about price ranges. And there'll be about three more videos or four maybe that will basically go through each concept that will build up to a model that I'll be introducing to you that you can use to assist you in getting better trades and having a better win rate as it relates to trading. So I hope this will be helpful and informative, and I hope you'll be able to apply the concepts as they are brought forth. All right. Thank you. All right. So in terms of what will be introduced, it's more on the side of SMC and less on the side of Stacy Burke. In some ways, I have found that there is a mixture in terms of, for example, the opening range initial balance would basically be that trading concept by Stacy Burke would basically be a one shot, one kill by ICT. It's just shown in a different way and explained in a different way and applied in a different way. Uh, but at the end of the day, it's what resonates with each person and what you find to be easier to be applied to actually give you real world uh, money in your bank account, put it that way. So the point of it is to actually be successful at trading and you use whatever works for you as best as you can. So in this case, uh, I'll be speaking about ranges, as I said before, and I've found that there are two types of ranges. You have time-based ranges and you have price-based ranges. And as the title says here, the truth has always been in front of your eyes. And that is so true. Because we would have heard, I'm assuming that most of us would have heard the terms dealing ranges, we would have heard about power of three, meaning how a candle forms, the accumulation, manipulation, distribution, and probably would have heard about turtle soups and stuff like that. Turtle soup in itself is like a Judas swing where there's a liquidity sweep and price reverses in the other direction with volatility or momentum. So just to give you an idea of what is to come and how everything will come together to create this model. And so let's continue. Sorry. So as I said, in my opinion, ranges of price can be time-based or price-based. I've found that time dictates price. So time is the foremost element that we should always be paying attention to. And the types of time-based ranges that are there include session ranges, so like Asia, London, New York, the afternoon session, the days, weekly. So we have Monday, Tuesday, Wednesday, Thursday, Friday, or we can have week one, week two, week three, week four, that's a monthly. And if we're going into the yearly cycle, you're looking at month one, month two, month three, etc. And of course, price ranges are quite simple, a range of probably 100 pips or 1,000 pips, depending on the instrument that you're looking at. And as I said, time always dictates price. What you'll find is that price will do what it's supposed to do at the time when it's supposed to do it. It's not going to be the other way around. So how do you apply price ranges to your trading? You can use it to project price swings, and you can use it to project entry and exit points. But what I will do is I will go into the charts and I will give you some examples that you can use. And what I will be asking you to do is to use the time after this video to go into your own charts to look and see if you can uh, just for your own what I would say tape reading, and for you to build your memory and to be able to identify these over and over, just to study your charts and see what you see when you look at these particular ranges. All right, so let's get into the charts. So as I said, we have session ranges. So we know that session ranges can include, I didn't mark the session ranges, but we generally know that session ranges would include Asia, London, New York, and the afternoon session. Asia being from the close of the previous day to midnight, 12 a.m. London being 2 a.m. to 5 a.m. New York being, I'd say from 8 a.m. to 12 p.m. Yeah. So that would be the New York, London, Asia. If you're looking at the weekly range, you'll be using Monday as the price range that you're looking at. So the high and low of Monday. And you basically use the projections of this. Two projections, I would say, meaning standard deviations. So, for example, we take the high and the low, and let me do this the other way around. Take the high and the low. Self and the magnet is not so handy, but let's go. So, assuming that's the range, we have a projection. So we're looking to trade just one or two trades for the week. And so we're not looking to trade each day. So we're looking for that projection that takes us to a PD array, for example. So it's an imbalance, and I work mostly with imbalances as opposed to order blocks, etc. So a balanced price range and a fair value gap, or it can be volume imbalance, stuff like that, or the gaps that open when the week opens or the day opens, those type of gaps. And what you'll find is that when you apply the projections to the range, you'll find that it lines up perfectly most times with a PD array. So that's what you'll find, and that's where you'll find your entry points. And of course, you can refine your entries as much as you choose to. And the idea is to take profits. We can use the same ranges to take profit. So you can decide if you want to do 1 to 3, also 3 standard deviations of the range, or 2.5 or 2, whatever your risk tolerance is and whatever your profit targets are. So that's the idea of how you apply the standard deviation to the ranges. So that's how, if you're looking to take 1 or 2 trades for the week, you use Monday's range. If you're looking to take session trades, then you would use the either Asia, London, or New York. Most times Asia would have been the well, this is assuming that this is Monday. This is not Monday, this is Asia. But if you're using Asia, if you're using this, if you're looking to trade New York or London, then it's best to use the Asia range, which is the accumulative range for the day, most times, to set your projections and to look for your entries and exits. And this is what I meant to say. You would have used the entire range of Monday to find a projection for the week, and you're looking to use to catch the expansion for the week. This would have been a great example. We had a stop hunt here and price moved from one end of the range to the next. If you wanted, you could have taken another trade here, and another trade. Well, I would not have taken a trade here, still inside the range, but anything outside of the range of Monday, you could look for a trade back inside the range or to the other end of the range. So that would be the idea there. And of course, if you're looking to swing trade, then you would be looking at the first week of the month, the first full week, because in this case, February would have started on Thursday, so you would not be using the first or the second or third or fourth. You'd be starting from the 5th, so the first full week of that month, and you'll be using that range to catch the range for the rest of the month if you're looking to swing trade. So that's the idea. So would have had that stop hunt outside of the range, and that would have been that monthly range coming straight into March. So that's the idea in terms of using your ranges, time-based ranges, and I emphasize time-based because we are using time more than we are using the price to find our entries and to get those projected swings. We're looking at the week or the day or the session. And if you want to be more granular, you can go into micro sessions, etc., but I don't think it's necessary. I think the deeper you go, you can get more confused at times, unless you are that genius or wizard and you prefer or like to do those things. But yeah, that's the idea. And of course, as I said, the time dictates the price, because whatever range Monday sets, for example, here for the week, you automatically get the price from doing that. So the time dictates the price. And the same thing for the weekly to give you a monthly range. You have the first week of the month, full week, that is, and that is the time dictating the price. So as I said, I hope you can go into your charts, do some studies. Let me give you the settings for the this. It's a GAN box. We basically use the price levels here. Sorry, is that the case? Yes. So 0, 1, negative 1.5, negative 2, and 1. And 1, yeah, all of these. You just apply those settings and it will give you the projections that you see on the screen. You can always pause it and look at it. Okay, so I hope that was clear. I hope that you can see through how these things have always been in front of your eyes and maybe not have been applied in the way that I just showed you, or maybe you weren't aware of how it could be applied in this way. If, of course, you have any questions, you can put them in the comments. I'll be sure to answer. I try my very best to answer all questions or reply to every comment on the videos. And the next video will be going into Power of 3 because it greatly applies to all of what you're seeing here in terms of the ranges and of course accumulation, manipulation, distribution, and you can have continuations or reversals after the distribution. So we'll get into that as well, and we'll go into the stop hunts, the turtle soups, the Judas swings, and then hopefully at the end of that we can put together that model that I'm speaking about and show you how you can apply it in full swing to your trading, right? Thanks for watching, and I hope this was of value, and look to see you again soon. Take care. Bye-bye.